Welcome to today's Corporate Venturing Insider series. Today I'm very excited to have Bobbin Franklin from NVCA. Bobby, welcome.
Thanks for having me. It's great to be here.
I know it's going to be great, but let's start with you, Bobby. Can you tell us your journey into venture capital? And what's interesting is that I also come from the wireless business. I know you're in CTIA, so we didn't have the obvious journey into venture capital. So please tell me.
Well, let's see. I'll try to make it's almost 40 years now. Quick. I grew up in Arkansas. I went to the University of Arkansas. I got a finance degree. Thought I was going to Wall Street, and in the meantime, got offered after I graduated a 6-week internship on Capitol Hill here in Washington D.C. And so I came to Washington, and as a lot of stories go for people that come to Washington, I came here for 6 weeks and I still haven't left. So I worked on Capitol Hill doing public policy for a senator from my home state. He retired. I got out and did what a lot of former Hill staff do, become a lobbyist. And I worked in telecom for a company also headquartered in my home state, which was Alltel. And I was their lobbyist, and then I ran their DC office, and that sort of got me engaged in the Wireless Industry Trade Association. And so at some point, they got a new CEO, and that CEO basically recruited me away from Alltel, and I went to work there first as their head lobbyist and then as their number two. And after 8 years of that, I got a call one day from a headhunter, and they said, NVCA. I said, what's that? I've never heard of it. And the more they explained it and described it, and they said, look, we're looking for somebody that knows how to lobby and impact public policy. We're looking for somebody that has some trade association management experience. It was just kind of a unique thing. And we'd love it if you also had venture capital in your background. And I said, well, I have a finance degree, so I kind of know what you're talking about. And ended up getting the job. And that was back in 2013. So here I am.
Wow. Okay. That went very fast, but there are two words which I want to touch on. First is Washington and then lobbyist. So what's so nice about Washington? And I need to say I've been to Washington a few times on holidays and it's so lovely. But please tell us why Washington is so nice.
Well, it's I guess it's nice. It's sort of like beauty is in the eyes of the beholder, right? A lot of people look at Washington and they can't stand everything it represents. We've enjoyed living here, my wife and I, and raising our kids here. Of course, now they're much older, but I feel like Washington is one big small town. And growing up in
Mm,
Arkansas, so it's very natural for me to operate in that environment. And what that means is if you're involved in public policy, you 1 or 2 degrees of separation from everybody else that's involved in public policy. And so
mm.
it's a nice hometown feel to it in that regard, at least for those of us that work at the intersection of policy and business or finance, as the case may be. So I enjoy that part of it.
Very nice. And you have the full 4 seasons.
We do have 4 seasons, and lately we've gotten most of them in the same day. We went from last week; it went from 85 degrees one day to the next morning it was like snowing, and similarly, just a couple of days ago it was 70 something degrees, and this morning it was freezing. So we're in that whipsaw springtime weather with storms coming in and everything else.
Okay. Now the second word is lobbyist, and you started very early to be a lobbyist. Can you share a little bit? Because for some people it's loaded, but clearly we need good policies for governments to function well, for the economy to thrive. Can you share a little bit about why did you become a lobbyist and what's the value of lobbies?
Well, the reality is policymakers here in Washington can't possibly know all that they should know when they're making the serious decisions that have significant impact. And so lobbyists perform a vital role, and there's always a lobbyist on both sides of issues. So it's not like, the lobbyists only are one sided in any regard. So I look at it as a public service, something enshrined in the First Amendment, the right to petition your government. And making sure that policymakers are better informed so they can make better decisions. And that's really the way I see the role of lobbyists. So I know it's a much maligned profession from time to time, but I wear it like a badge of honor.
Very nice, which leads us to NVCA. Can you share what the NVCA is about and maybe some of your recent success?
Sure. So NVCA has been around since 1973. We celebrated our 50-year anniversary just a few years ago. And it really started kind of when the what I would call the birth of the modern day industry started, which was kind of in the 70s. There had certainly been what people could look back and say there was venture investing before then, but a couple of things happened. Some of the early investors in the 70s came to Washington, and there were two issues that were primary functions to really make the venture industry what it is. And those early pioneers came here and they lobbied for one thing, which was to lower the capital gains tax rate, which at the time was very high. And they lobbied for a change in the ERISA rules, which then allowed pension funds to be investors in alternative assets. And most people look at those two happenings in the 70s as when venture really started to take off. More capital was formed, more check writers started deploying that capital, and more entrepreneurs were able to sort of take the risks that they do to try to create something big and amazing. And, when we look back and think about all the different policies that have been debated since then, NVCA has a multi decade kind of history of success. Doesn't mean we win everything, nobody does. But there are so many points along the way where there were significant policies that would have harmed the entrepreneurial ecosystem. One that pops to mind and I often give as an example is back in 2017, there was a tax bill that was moving through, and policymakers thought it would be a great idea to change the taxation of stock options to when they were vested versus when they were exercised. And if you think about all of the entrepreneurs and all the people that work at startups who don't take salaries, instead take equity positions, they would have had a massive tax bill just because they had worked at a startup for a while and became vested in their stock options with no ability to pay a tax bill. And oh, by the way, as we know, one study we often cite is that over a 10-year period, 75% of all venture investments fail. So you would have had people working diligently in the entrepreneurial ecosystem that would have had a massive tax bill. And in this case, 3/4 of them wouldn't have had anything at the end of the day for the government to justify having charged them that tax. So that's an example of where we have to jump in, wave our hands, and go, whoa, 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 you don't understand the detriment you're going to cause to something that is so vitally important to our country and frankly to the world.
And I think the example you give about pension funds being able to invest, not every countries have done that. And I'm guessing this is one of the major inflection point for the US venture capital economy.
It is. And, I think that's a great example of why the US continues to, I would say, maintain its market share lead with regard to venture dollars being invested in a country. I think another one that I noticed and learned more about in these last 14 years I've been here is that there is a certain acceptance of failure in the United States, which is just one step closer to success. And you go back and look at all the famous entrepreneurs, and they can tell you about all the failures they had before they really, kind of hit the idea that ended up being so successful. And a lot of cultures around the world don't have that. And if there's failure, I mean, gosh, people can lose their passports. They can go to jail. There's all sorts of bad things happen to entrepreneurs. And so that really, for large parts of the globe, restricts the entrepreneurial activity that they have. And so that and good policies and other things, I think, help explain why the U.S. Sort of invented the idea of venture capital investing and continues to dominate.
Actually, it's interesting. In French, it's called capital risk capital. But it doesn't feel like in Europe, and maybe you can help me here, it doesn't feel like the risk appetite is the same as in the US.
I think that's right. And, you know, I used to talk about back in 2013 when I started, I used to tell policymakers, you have to understand how the rest of the world is getting off planes, Silicon Valley and other parts of the US, and they're observing what we're doing well. And they're going back to their countries and they're trying to mimic it. And, you know, the market share of venture dollars in the US was once 80 or 90%. And then in the 2013, 2014, it had gone down to, we were less than half at one point because other countries did kind of figure out what you need to do. Now it kind of went back up. I think I want to say it's in the six. I don't have that data figure with me right now, but I want to say we're above half now, probably in the 60s or something, maybe higher. But it's a reflection for each country to, I think, kind of look in the mirror and say, what are we doing right? What are we doing wrong? And by the way, that, NVCA exists because the US does a lot of things wrong. And we are here to point out when they do things wrong and try to get them to do things right.
And maybe we'll talk about that. But I want to shift gear towards corporate venturing. So the audience are people in corporate venturings, maybe in corporate VCs, or thinking about starting a corporate VC. And we've seen so much more, and we talked about this in our preparation, so much more alignment in the last 10 years
Yeah.
between VCs and CVCs. You even have more and more engagement with NVCA and corporate VCs. Can you speak to the last 10 years
Yeah.
and how you are optimistic, I know, about the stage today, and maybe we'll talk about the future afterwards.
Sure. Well, if I look at our data is PitchBook data, but if I look at our data and go back to 2015, if you looked at all deals, corporate venture was 53.6% of deal value back in 2015. And if you look at last year, that's climbed to 63.4% of deal value that CVCs have been part of. CVCs now participate in 1 in 6 startup funding rounds. So they're ever present. 3/4 of the deal value go to Series B or later. 2/3 of the deal count goes to seed or Series A. And obviously, talking about value in later stage versus the number of deals makes sense to those that understand the space. So it's really demonstrating in mass sophisticated investor behavior, right? And thinking about all stages of investment. VCs, kind of provide agility. CVCs offer the kind of mothership resources for scaling. And so much that's important to a young startup. If you look at AI, which is obviously the investment du jour, CVCs committed 82% of their dollars to AI investments and participated in 68% of all AI deals. So, I mean, those are just some stats to show kind of what's happened over the last decade. And it's impressive.
And I think you hinted to it, but there is value from the mothership. How do you see that becoming? I mean, when we talk about AI, I mean, we think about OpenAI and all these companies.
Yeah.
Corporate venturing has been core to them being catalyzed to success.
Absolutely. Think about what Microsoft did all the way when OpenAI was before we started talking about ChatGPT and stuff, right? I mean, it's such a, I think, real success story showing the value and the important role that established companies continue to play in what I always refer to as the entrepreneurial ecosystem and the next great thing.
So there are some entrepreneurs watching this interviews, if you were to make the argument for them, why include corporate VCs in your cap table? Why not? Because clearly, not all corporate VCs are born the same,
Right.
and some are good and some are not so good. So, what argument would you make to the entrepreneurs?
I think to the entrepreneurs, and every entrepreneur, depends on kind of what your space is. I understand the complexity. I understand the wide variety of entrepreneurs out there. I mean, we have advisory committees of our members that focus on life sciences, that focus on energy, that focus on crypto, blockchain, that focus on, you name it, right? And so it's all
Yep.
over the place. And so it's not a universal blanket, set of kind of thoughts or advice. But when you look at the data that I just shared over the last 10 years, clearly so many entrepreneurs and founders have found value by having CVCs on their cap table for a variety of reasons, right? And that success rate and that increased participation would not happen if folks were, saying that this doesn't help me, right? And so I think the data sort of speaks for itself, and there's tons of anecdotes of where we see it kind of live and in person. But I think as an entrepreneur, you have to think about, how could somebody on my cap table that has things beyond just a check,
Yep.
resources, the ability to, test things, the ability to kind of work inside the environment of other corporates, certainly if you're a B2B type play, that you're going to want to have better visibility into, greater feedback from. And I think that, the data shows that it continues to be successful.
Now I will change persona. So in the audience, some are the CEO of companies. They're thinking about setting up a corporate VC or a corporate venturing unit. Why do they need to be part of that conversation about innovation policy, capital formation, and why should they work with NVCA? Because NVCA has been mostly VCs, but you start to have corporate VCs as members. So how should the CEOs of these companies, when they are thinking about building a corporate venturing unit, how they should be thinking about that?
If you think about the entrepreneurial ecosystem and the role that venture capitalists play, both traditional VCs as well as CVCs, and how important it is for us all to be aligned, right? And for the success of the portfolio companies, which we all want to see happen, the policies in Washington are so important. And if there are policies that are making it harder for corporations to be CVCs, that should matter to a traditional VC. Similarly, if there are policies in Washington that are hurting traditional VCs, then that should matter to corporate VCs, right? It's like we're so small as an industry together, right? We've got to band together and address the issues that are going to make a difference for everybody. And if you look at our policy agenda, by and large, when I go down our issue matrix, almost all, there's a few exceptions, but almost all of the issues we work on are to the direct benefit of the portfolio company. And it doesn't matter if you're a CVC on the cap table or a regular VC on the cap table, you care about what matters to the portfolio company. And that's why we need everybody at the table working on kind of what's important to the portfolio company. I mean, that's what we're focused on.
And arguably, you do well for entrepreneurs, of course, that you do well for VCs and CVCs, but you do well for the country.
Yeah. Yep. And it's, I think some of the issues, I'll just start to think out loud about what are some of the issues to give examples of what I'm talking about. And obviously, we're focused on trying to reduce the regulatory burden from the Securities and Exchange Commission with the change in administrations, with the new chair of the SEC. I mean, we had great difficulty with the previous chair, Gary Gensler. We love Chairman Atkins, and he is somebody that I think can help us get regulations in a better place. So, as he likes to say, let's make IPOs great again. Let's make it possible for some of these portfolio companies to go onto the public markets, which they haven't been able to. Talking about what's important to traditional VCs, so much happens in the private markets these days because it's been harder to get in the public markets, and more capital has been available. But traditional VCs that enjoy what's called the exempt reporting advisor status at the SEC have a 20% bucket for non-qualifying investments, and secondaries, which have been such an important part of the success of portfolio companies and their continued journey. This 20% bucket is this ceiling because they don't want to have to become registered investment advisors and all the complexity and expense that comes with that. I mean, remember, the median size venture fund that was raised in 2025 was only a little more than $26 million. And so,
so half is below.
Half is below. And so think about how small they are and how, they don't have the resources to pay lawyers and everybody else to become registered investment advisors. And so we have legislation we're working on. We've gotten it through the House, trying to get it through the Senate, that would raise that 20% bucket up to 49.5%. I think that is good for all portfolio companies. It gives more availability of private capital at times when they may desperately need it in their valley of death scenario, right? And so I think that's why a corporate VC should care that we're trying to help traditional VCs deal with this regulatory, kind of headache. Advocating for M&A policy. I mean, we hated the previous administration's stance on basically saying there shouldn't be any M&A, or at least that's what signal it sent. So for those corporate VCs that are part of this for strategic optionality, it's hard. If you see something that you would like to acquire and take on, and not every company is meant to be a public company, and mergers and acquisitions are the most likely or most in numbers and value and everything else, the better outcome for entrepreneurs and portfolio companies. So we want to try to make a difference there. And then there's always tax issues that impact both corporations, but the mothership as well as the entrepreneurial ecosystem, like in the so-called big beautiful bill or big ugly bill, depending on your politics last year. The R&D expensing issue helps corporations as well as helps portfolio companies.
Yeah, I think I want to double click on the going public or not going public or lack of M&A, because clearly that has been a challenge for VCs. Yep. Less so CVCs because of the way it's constructed, but for VCs not to be able to return capital to the limited partners, which then can recycle back to VCs. And there's a virtuous circle that happens when you do have these exits. But it does feel like, we talked about the last 10 years about what has changed about corporate VCs, but it nearly feels like the cachet of having an IPO is not the same as it used to be. And some of the most amazing companies have stayed private way longer than it used to be. And maybe that's where it touches secondaries, which is it still allows for some DPI, some distribution back to the LPs while the company stays private longer. Can you speak to how you saw or how you're seeing the challenge of not going public or not getting exit, and how difficult that makes the VC ecosystem thrive, especially when you mention so many VCs are actually small size?
Yeah, absolutely. So, I mean, if you look at all the data that we put out every quarter, where you see the stark pain in the industry is fundraising. And so we aren't seeing the ability for venture funds to be able to raise funds like they were able to in the past, 7 years, right? And that is a direct result of the lack of distributions. And the lack of distributions is a direct result of a lack of exits. And a lack of exits is a direct result of public policies that inhibit sometimes both IPOs as well as mergers and acquisitions. So if you think about what's hurting the industry today, it all leads back to making sure public policy and policymakers understand and appreciate what it takes to make sure this ecosystem survives and thrives.
All right. So I'm going to ask you an interesting question, I think. Let's assume you have a magic wand and you could choose a policy that you believe is perfect, but it can only fix one thing. Perfect for secondaries, perfect for IPO, perfect for M&A. You can only pick one. Which one would you pick and why?
Oh, wow. That's hard. I think at the end of the day, it would my magic wand would have to center, and this is a data driven answer. It would have to center on making sure M&As were allowed to happen more than they have been. And the only reason I say that is because when you look at uh, data and studies, the one that I cited where 75% fail over a 10-year period, looking at all venture investment, of the 25% in that study that succeeded, 18% had an M&A outcome. Only 5% went public because, again, not every company is meant to be a standalone public company. And only 2% stayed private for one reason or another. So I think the most successful and important exit opportunity outcomes are around M&A. So if we could wave the magic wand and make sure that we didn't have the friction in the antitrust rules and the merger and acquisition process and what the FTC and DOJ kind of the role that they play in there, that's where I would want the magic wand to be focused.
Yeah. And I mean, I've been doing corporate venturing since 2019. M&A can be such an accelerant to the project of the founder into a bigger platform. So I do see your point about the exit and recycling of capital, but also making that project even more successful.
Right. Absolutely. And this is, obviously this really hits the Venn diagram for both the mothership and the CVC, right?
Exactly. I was getting to that, which is how do you see corporate VCs in the M&A context as, on one hand, they are clearly a good path for entrepreneurs to think about corporate VCs, but at the same time, they might be worried it comes with hooks and it could be dangerous to have a corporate VC on your cap table because of what it could imply or at least signal. How do you think about that?
Well, you see a lot of portfolio companies that have more than one CVC on the cap table, so that can help create some balance there. And I know that there have been examples, and I'm sure, some lore around folks that wish they didn't have a certain CVC on the cap table because of what you're describing. They wanted, greater rights and so forth. I think with the increased participation that we've seen over the last decade, I think more people are aware of some of those challenges. And I think they're better able to navigate that. So I feel like it's probably less of an issue today than maybe it was 10 or 13 years ago when I started here. I feel like that's something that is better known by all participants. So everybody should go in with their eyes wide open, right? And understand there's pros and cons, which outweighs the other.
I always say ask plenty of questions. Make sure that you choose your corporate VC or your VC well.
Yep.
Ask questions. So it leads me to one thing which may not be obvious for our audience, which is you and NVCA are very, very focused on raising the bar, bringing quality training to your members. And that's not an obvious thing to do for a lobby organization. Can you speak to why this matters to do training? And we just had one of our colleagues coming to one of the training and she loved it and it was high quality. So you're not just doing it for the sake of it, you're actually doing really high quality training. So why?
Well, first of all, I think that's part of the role of a trade association to understand kind of what all can we do for the health of the industry. And obviously public policy is a lot of our focus because it takes so much time and effort to do it well, do it right and have success. But there are other things that a trade association should sort of be responsible for. And I think of it as, what can we do to make sure the industry is the best version of itself?
Mm,
And, a little over 5 years ago, we publicly launched what is now known as Venture Forward. And it's basically a 501c3 tax exempt foundation that essentially is taken on kind of the education role. And if you go back decades, there was something, it may still be going on, but NVCA was part of helping set up something called the Venture Capital Institute. And if you talk to people who've been in the industry a long time, they, harken back to the days that they went for a week in Atlanta at Emory University. And for reasons that I don't fully understand, because it happened before I was hired here, NVCA wasn't a part of that. And so when we launched the 501c3, there were a lot of things to align with its mission. And one of those was sort of democratizing access to information and education about venture investing. And we sort of started with a program that we call VC University, which really just helps open the aperture for a lot of people to understand what venture investing is about. And that's an online course. And we have a partnership with UC Berkeley Law School, as well as now Stanford Law School and NVCA and Venture Forward. So the four of us sort of kind of operate this. And we've had almost between 5,000 and 6,000 people go through that. And it still has a net promoter score in the 90s. So that's been
great.
hugely successful. But what we've come to realize over the last few years is there's a lot more help, education, training. And so we've done a couple of new programs. One that you mentioned, one of your colleagues was able to join us a few weeks ago, and that's a new boot camp. It's like a 4-day boot camp, and this was the first one. It was at Stanford Law School in California. And, so far the feedback we've received from your colleague as well as other participants was very positive. And so I think there's something that we will try to continue to build upon and make it even better. We also were fortunate enough to get a grant from the Ford Foundation to create a master's class. And this was important. If you're a traditional VC, I know that everybody feels like the first fund's the hardest, but the first fund, the second fund, you don't really have a track record. People kind of think, well, we're going to continue to back you. But the third fund, it tends to be a kind of an inflection point. And so this master's class is designed to help those that are around fund three, because there are new things that they don't know that they need to be thinking about as they lead those firms. And so, we're very proud of kind of the role that we're continuing to create and play in educating kind of the next generation and making sure those that are in the industry continue on a successful pathway.
I think it's so important. I want you to maybe give 1 or 2 minutes description about this masters, what it covers, the time commitment, because you're talking about people who are at the fund three stage inflection point.
Yep.
That's when they might think they are too busy to do it. So if you can describe maybe 1 or 2 minutes.
Um, we'll continue to iterate. So whatever I say here may not be the way it actually comes out. But what we started with was like a couple of days, and to learn from those who have successfully raised 4, 5, 6, 10 funds. So the leaders in the industry, the ones that are in the give back phase, the ones that are, no VC ever retires, I've been told. They just aren't part of the go forward fund, but they're still in that 10 or 15-year journey on the last fund they raised. So many of them have sort of stepped up, and great leaders and former board members of NVCA have said, hey, I've got knowledge that I'd like to impart on those that are building funds like I successfully did. And so it was a great way to sort of start, and with the support of the Ford Foundation, to get something off the ground. And we're looking at continuing that and see how we can iterate on it and make it even better.
Actually, I think part of the VC ecosystem is based on some level of apprenticeship and
Yep.
mentorship. It sounds like you're trying to make it more structured, more formal, more focused, but you still take people who want to build a legacy for the next generation.
Well, I think that's right. Think about, okay, we talked about the median size fund. Obviously, a median size fund of 26 million less doesn't have a whole bunch of GPs and a whole bunch of, mentorship opportunity for they don't probably have any young associates, right? They're not big enough to do that. And so this is a way to kind of take on part of that responsibility. And that responsibility has obviously changed over the decades. And COVID, I think, had a big challenge when fewer people came into the office. And how can you be mentored if you're not physically with somebody, more of the time? So you continue to see changes on what the apprenticeship model has done or will do in the future in our industry. And if we can kind of play a role of convening lots of young managers and lots of experienced and in the give back phase of their life folks, that's I think a good use of our convening time and power.
It makes a lot of sense. Now, when we talk about training, and we discussed it before this podcast, there is clearly value for this training to be having some corporate VC practitioners joining,
Mm-hmm.
as much as some VCs joining corporate venturing training.
Right.
How do you see that moving forward? If we think about the next 10 years, especially the numbers you just gave earlier, which is especially in AI, where corporate venturing is so big
Yep.
and so prevalent, how do you see that connection and maybe that intertwining between VCs and CVCs in a way that it becomes even more value for the entrepreneurs?
Well, it sort of goes back to looking at the data, understanding how the cap table has changed over the last decade. More CVCs are part of that. And I would answer it by also us imagining even further into the future. Think about non-traditional VCs that have come down and taken positions in venture-backed companies. Think about
Yeah.
LPs that are doing more direct investing. Think about
Yeah.
like participants that aren't from a traditional VC or a corporate VC, but are now finding themselves on the cap table. Like I can imagine that not only are we going to have the traditional VCs and the corporate VCs together, understanding what's important, learning from each other, but we're probably going to have to find ways to bring other people in that don't have the background that you do at a CVC or that you do at a traditional venture fund. Think about that, right? So then you've got LPs, or you've got hedge funds, or you've got people that sort of aren't in our world day in day out, yet are sometimes at different times playing bigger roles in the industry, on the cap table, on the board. So,
Yeah.
I think it's not only making sure CVCs and traditional VCs are together and aligned and learning together and understanding what makes each other tick, and the similarities, the differences, the opportunities, and the challenges. But I think that's going to continue to evolve in different ways.
Now let's move to policy. Let's start with a positive one, which is, what do you see as the biggest policy impact for startups? And I'm talking about at the moment.
Well, I mean, we talked about, if I had my magic wand for M&A, and IPOs and the exit environment, I think that's important. I think the damage that, frankly, the previous chair of the SEC, and I say this openly, and I mean, it was just a bad situation. There was far too much regulatory overhang, everything impacting our industry. In fact, we took them to court over one of the big rulemakings that they did in the last administration, and we won in court. Well, that's a expensive and time consuming process to have to go to a federal district court to get rules knocked out that the agency that oversees you does. There were 40 something rulemakings that sort of impacted VC. We took one to court and won. The new administration is trying to undo some of those, mini rulemakings. So there's a lot of work to be done there to kind of right size the regulatory environment for private funds. I think that if I sort of thought about what's important right now, what's top of mind, that's kind of where I think about. And that impacts all VCs. And again, even CVCs, because the others on your cap table, you might need them to be participating more with secondaries. But then I think about inside verticals, industries, and the fact that we don't have the market structure bill for crypto blockchain investors to make sure that we see the full potential there is something we need to get across the goal line. The fact that every day we see states with new AI policy and regulation and law, that if we have this patchwork quilt of a regulatory framework for AI, we're not going to see the full potential that we can or should see. So we need a federal regulatory framework. And to the extent that some of the states have done things that everybody believes is important, fine, just pull it up to the federal level. Let's have one set of rules, not 50 or more than that. So, those are areas, obviously, as we say in Washington, sometimes personnel is policy. And so if you're dealing with the FDA or Department of HHS, you're dealing with some different personalities today with vaccines and everything else. And that's a challenge for many of our investors, and what happens there is important. If you're investing in national security, defense related type portfolio companies, which we've seen a 25x increase in that, then you're thinking about acquisition reform. Just yesterday, as we're taping this, we got the SBIR, STTR program reauthorization through its last step, and now just waiting on the White House and the president to sign that reauthorization. So, there's any number of issues. It's why I shuddered when you said you got to pick one when you asked me the magic wand, because there are so many issues that we have to stay on top of on behalf of the ecosystem. We never have a dull day. There's always something happening.
No, and you talk about the patchwork and AI, but this is one where AI is so critical to a country's success.
Yep.
And it's not like you're alone in the race.
Yep.
Now, and you're probably going to have a different answer than I expect, but what do you see as Washington's blind spot on innovation?
I I think the biggest blind spot they have, and I say this because it's sort of the pattern that we get caught in all the time. They understand what big corporations, so all the CVC motherships, right? They all have plenty of representatives and lobbyists and consultants that make sure policymakers understand what already established big corporations need in public policy. And policymakers also have a really good idea of what very small business mom and pops need or want or desire. They're often the leaders in their communities as their constituents. They've known them for decades, and so they understand what small businesses want. A venture-backed high-growth company is neither a small business or intends to be a small business forever, or yet a major corporation. They're in this sort of in-between land that there's not a lot of us here in Washington helping policymakers understand what's important for those portfolio companies. And so I think the biggest challenge that sort of sums up everything we do is trying to explain to policymakers why they need to care about these companies, even when you tell them that 75% of them are probably going to fail. And it's like you're trying to help them understand that the entrepreneurial ecosystem backed by venture capitalists, both CVCs and traditional VCs, is essentially the outsourced R&D of the entire country, of every industry. I mean, I came from telecom. There's no more, Bell Labs that is back there creating the next generation of wireless technology, right? There's just constant evolution
Mm,
and innovation happening. And if policymakers appreciated and understood that this sort of in between small businesses and already established businesses where all the magic happens. It's where all the net new job comes from. It's where all of the innovation happens. It's what keeps our country competitive with other countries around the world, but it also helps those countries be competitive with us. And if they
yeah.
better understood kind of what this little slice is of high growth companies pushing the envelope of innovation with a high failure rate that's okay, because that means we're taking the types of risk we should be taking to push the envelope and make sure we're innovating as much as possible. If they understood that, that's where I think we could make significant strides towards the policies that are so important.
It's such a good point you're making. And I think it's not the visible part, yet it's such an impact. I'm probably going to use a really imperfect analogy, but it nearly feels like asking for politicians to care about teenagers who are not yet voting. And maybe not
Right.
all of them will end up voting. And yet, if you don't take care of the teenagers and the young before they get to adulthood, you don't have the future as a country.
Well, I have a chart that I sometimes put in presentations I make, and I haven't looked at it in a while, but you can go to the website and you can look at the most valuable by market cap public companies in the world. And normally, when I do the refresh on it, 8 out of the 10 most valuable companies in the world started with an entrepreneur and a US venture capitalist. And that I
And once you get SpaceX and OpenAI going public,
it,
then that
then
would
it'll
be
probably be
even
10
better.
out of 10, right? I mean, and so I think that's why policymakers, I use that chart to try to get them to understand that this is where the most valuable companies are born. This is where the most innovative products and services that change the world happen. This is why you need to understand why this ecosystem is a bit fragile, but is so important, and how you can make dumb policy decisions because you don't understand. You understand how it impacts already established companies. You understand how it impacts mom and pop, but you don't understand how it impacts a young, high growth company.
Actually, I think a good example of that, I think the term is regulatory capture,
Yeah,
which typically is the incumbents making sure that these upcoming companies, startups, VC backed, could threaten them. And they set up a way where it sounds good, but this is regulatory capture.
100%. And that's why, the regulatory environment and the rules of the road for AI fully developing, or crypto blockchain technologies fully developing, are so important.
Okay, now let's talk about talent pipeline. Where do you see the gaps in the talent pipeline in venture?
Well, that's what we're trying to address with our venture forward and all the education and so forth. I think the talent pipeline is, I hope it's strong. The thing I worry about is the opportunity pipeline. And that really has more to do with, the fundraising and whether or not their capital can be formed so that we can have more check writers in the industry. And you see the concentration of both the capital being raised as well as the capital being deployed, particularly in AI. that are going to, a few very large VCs or a few very big AI companies, and that worries me right now. I would certainly rather see the ability of first-time fund managers being able to raise a fund, and those check writers being distributed geographically all over the U.S., and if we make it to a bigger audience, all over the world. And that's so important because the very first checks are usually the ones that have to be right next door, either an angel investor or some seed stage investor that's right there next to the entrepreneur. And so it's been concentrated in hubs across the globe, certainly in the US. If that were better dispersed, I think it would be so much better for the entire entrepreneurial ecosystem. Obviously, once a company gets to, their D, E, F, G, whatever SpaceX and some of them are up to now, I mean, growth capital travels just fine. It's that
Yep.
seed stage and those first checks that are so difficult for the entrepreneur. And so if there was a greater disbursement, and in order for there to be a greater disbursement, there has to be a greater ability to people to be able to raise funds. So I think of that as the challenge. And certainly it's one of the things that we kind of think about and trying to make sure capital formation can happen in the right ways and the policies are there to enable that. I think of that more than the talent pipeline. I think if the opportunity pipeline is there, the talent pipeline will be right there with it.
Well, thank you for setting all these trainings and curriculum, because I made a bet on this podcast with Stanford professor Ilya Strebulov, where I think that we may see 10x the number of CVCs in the next 10 years, from 3,000 to 30,000. If that's true, then you do need a lot of what you call check writers, investors, engagement team, and all of that. So I, I definitively see more opportunities to build more good investors, to allocate capital to early stage companies for them to grow well. So
Well,
yes.
there's actually um, a great data point and sort of case study to look at. Not many years ago in Austin, Texas, there was pretty much one venture capital fund, Austin Ventures. And for entrepreneurs in that region, if they didn't get a check from Austin Ventures and they went somewhere else, the somewhere else would say, well, why didn't AV back you? And they go, well, they already
Yeah.
had this. Right. They already had this, competitor or something in their portfolio, and they didn't want to back two companies doing the same thing for whatever reason. But it was the kiss of death to entrepreneurs in Texas because there was sort of one sheriff in town.
Yeah.
I think
No competition.
and now you've seen the opposite, right? You've seen people migrate to Austin from California. And now you really see kind of a robust entrepreneurial ecosystem in Austin that's bigger and I would argue better than it was when there was sort of one game in town. And I think that's a great kind of case to make for the importance of a lot of check writers and capital kind of distributed in lots of different hands to be able to support the entrepreneurs.
Now, my next question is going to be about this distribution geographically, because it's an opinion, I'm sure. Do you wish the US to have more distribution in terms of entrepreneurs and VCs across states? Or do you think the US is more competitive because it's so concentrated into very few ecosystems?
I think it would be so much better for the US if it were better distributed. And if it were in different geographies across that, there are entrepreneurs everywhere.
Yep.
But if they're not supported by an ecosystem that can give them those early checks, then we'll never know what they could have done. We'll never know what great innovation they could have made to society. And so I think it's important that we kind of think about what could make other geographies more healthy, even more countries. And so I would like to see it dispersed even more.
Yep. I agree. Entrepreneurs are everywhere, and you need the right ecosystem and support system for them.
And it would
I want,
certainly make my job easier if we had more constituents for other members of Congress that were, in other states that were greater participants in the ecosystem.
yeah. So I have two more
Yep.
questions. One is about AI policy. What do you see the AI policy you're seeing today, the implications for venture?
Well, I think we hopefully can get this patchwork quilt of state by state under control, and we can have a clear set of rules, because that's just an overall drag on what AI can fully accomplish. And I think it's important for us to kind of address that. I guess just personally, I'm interested to see the next evolution, beyond the large language models. How are when we get to small language models, when we get to AI serving very specific purposes for very specific reasons that show significant, increase in whatever the metric that we want to see increased is. So I'm looking forward to the next phase of what AI can accomplish and do. And I just, hope that we can get the policy in the right place so that can happen.
Yeah, I think some of that is edge computing. We just made an investment in our very first Japanese company, Edge Cortex, which is about edge compute. And I think you're right. We are going to see way more diverse type of distributions of AI, and that's going to create more use cases, which is going to be quite remarkable to watch and to invest in. My last question for you: what do you think matters the most for the next decade?
Well, I it's an obvious answer for me to give, which is I think policy matters the most over the next decade, because I've seen how it can really screw things up, and I've seen how, when done right, things can happen. And whether you're trying to get procurement reform so all the new defense and national security type technology can make it into the Pentagon and into the warfighters' hands, whether you're thinking about the amazing innovation that can happen with new drugs or new medical devices, whether you're thinking about the energy needs from AI, and whether or not the company that is pushing the envelope over nuclear and bringing that back and being able to support the energy needs of not only the ratepayers and the citizens, but also the increasing needs from the AI infrastructure. Everywhere you look, there's a need for innovation. And in every corner you look, there's a way that public policy can help or hurt. And so I think the most important thing is that we gather the participants in the industry, because we're a small industry, and make sure that we're convened around what needs to happen so that everybody can succeed.
Well, Bobby, I think you made a very good case for thinking about policy early enough so that you can have the right inflection point. Thank you so much for your time today.
Great to be with you. It's always fun to talk, and I appreciate you having me on your show.
Thank you.